During the first half of the year, two main things happened. One is the price of risky assets moved up very significantly thanks to solid and positive fundamentals. And secondly, the dollar decline, second thing which we will try to explain. Stock market went up very significantly during the first part of the year. This is due to positive fundamentals, and the first is economic growth. We have a moderate but solid economic growth in mature economies, and very importantly, it's a synchronized economic growth the first time in this economic cycle, meaning that all mature economies are contributing to growth. In consequences, earnings are well oriented, and the corporate sector is going to deliver double-digit earnings growth this year, which is of course a very strong positive. And for the first time also, analysts are beginning to revise upward their forecast for this year and next year. Inflation is not accelerating, so in fact all fundamentals are well oriented. However, there is nothing new in all those positive factors. So the markets are already discounting those positive items. And we think that for the short term, markets need to consolidate this first leg to the upside. Then, after a period of, let's say, a couple of months, this overbought situation will disappear, and later during the year, the uptrend will be able to come back. During the first half of the year, the dollar was weaker than expected, and in fact it declined by 5% trade-weighted and by 9% compared to the euro. We think the extent of the decline is clearly exaggerated by the markets. And there is a combination of three factors to explain that. First, on the political side, the European political situation improved mechanically after the French presidential election. The German elections are not a subject for the markets, and no one now anticipates Italian election before year-end. So the subject of tensions in politics in Europe will come back only next year with the Italian election. At the opposite, in the US, the tensions in terms of politics continue on the same way. And by tension, I mean that the Trump administration is not delivering in terms of fiscal stimulus package. The Trump administration is not in a position to reform Obamacare, so they don't have room to maneuver to extend the fiscal stimulus. However, we think that the markets are too pessimistic today, as they were too optimistic just after Trump election. And our scenario is that the Trump administration will deliver a package, a very classical Republican package, before year-end with a decline of taxes. The second factor is monetary policy. In the US, the Fed is tightening. They have done several times 25 bips to the upside, and we believe they will do one more this year and 3 hikes next year. The markets do not believe so, and that's probably because of the first point on the fiscal policy. However, we think that the US economic growth will be above 2% and that the Fed needs to regain some momentum for the next economic cycle, meaning that the normalization of monetary policy is a very important subject for them. So they will increase interest rates even if the markets do not believe so currently. In Europe, the market at the opposite moved very rapidly to the anticipation of changes in the ECB monetary policy. We think that the markets are too rapid on that aspect, and the ECB will not change anything before the German election. They will talk only in September or October about political changes, and that will be implemented only next year. So again, we think the markets are exaggerating. The third factor is concerning bond markets. Bond yields moved up more rapidly in the US than in Europe, and we think it's not logical because inflationary pressures are more important in the US than in Europe, because the employment level in Europe is higher than in the US, so we think that inflation will accelerate first in America and then on in Europe. So we believe that the steepening of the yield curve in the US will come back as the main source for the rising dollar. We don't know exactly what will be the trigger for rising dollar, but we stick to the conviction that the dollar will rise to 105 in 12 months, even if we lowered somewhat our expectation for the next 3 months to 110. So we don't change any country recommendation. We stick to the positive view on Eurozone and Japanese equity markets, neutral on the US, UK and emerging markets. We changed somewhat our recommendation on a sectorial basis toward more defensive positions. We moved to an underweight position on the automobile sector, and we take some profit on the technology sector, so to a neutral position. At the opposite, we increase our weighting on the utility sector to a neutral position. Thank you for your attention and enjoy summer.